Well, welcome everyone to the Kimberlite webinar to take a comprehensive look at the subsea equipment market. My name is David Batt, President of Kimberlite Research, and I'm glad that you're able to join us today. Although my camera is not working today, I will continue forward today with the audio. Keep in mind, this is the 19th in the Kimberlite webinar series, and our past webinars have included reviews of drilling services, artificial lift, cementing, surface wellheads, hydraulic fracturing. Even most recently, earlier this year, we took a look at the big three oilfield service suppliers, Halliburton, Baker Hughes, and Schlumberger, as well as take a deep dive into the Permian Basin and the competitive landscape of the suppliers for drilling, completion, and production services in the Permian Basin. Last month, we took a look at the G&G software market and digital technologies. Let us know if you or your colleagues would like access to any of these prior webinars to send us an email or a chat message today. Today, we'll be taking a deep dive into the supplier performance for subsea equipment. That includes subsea trees, control systems, umbilicals, manifolds, as well as addressing many of the technologies that are driving the future of the subsea market. Feel free to submit questions during the presentation today via the chat box, or you can email us, and we'll address the questions during the presentation. For those of you that are not that familiar with Kimberlite Research, I'll provide a brief background and then dive into the review of the subsea equipment market. Each year, Kimberlite conducts about 3,000 one-on-one interviews with oil and gas operators and users of oilfield services worldwide. Some of you on the webinar today may have participated in one of our industry studies in the past, and for that, I say thank you. Our research is about 50% international and 50% North America. Based on these 3,000 one-on-one phone interviews each year, we produce a series of reports covering geology, geophysics, information evaluation, drilling, completion, production, subsea, and pipeline integrity. Today, we'll be addressing interviews that we recently conducted in February, March, and April of 2022 with about 100 subsea oil and gas customers worldwide responsible for managing over 4,800 subsea wells. We'll cover, like I mentioned, trees, control systems, umbilicals, and manifolds. In the alternating year, say for 2023, we'll be addressing subsea services with equipment maintenance and repair, ROV services, and test trees. And each year we do update subsea wellheads. The findings in the data set that we present is fairly rich and multidimensional. In this one particular exhibit, we cross-plot supplier performance on the x-axis versus pricing competitiveness on the y-axis. And before diving into the data, I just want to make sure everyone understands these four quadrants. The value map, as we refer to it at Kimberlite, is effectively a visual picture depicting the competitive positioning of each supplier. The top right-hand quadrant, known as the premium offering quadrant, is where suppliers that are typically charging prices perhaps a little bit higher than industry norm, but they're performing better than industry average, and so they cost more, but they're worth it. They're premium-based suppliers. Bottom right quadrant is value advantaged. Suppliers in this quadrant are positioned to grow market share. Bottom left are discount providers. The suppliers underperform industry averages, but they charge a lower price, but they're well within the fair value fairway that runs diagonally so that you get what you pay for. And the top left-hand quadrant is the value disadvantaged quadrant. Any suppliers that are viewed as performing below industry average and are competitively disadvantaged with respect to the overall market are really positioned to lose market position and need to put in place a recovery plan or adjust pricing strategies to move back into the fair value fairway. You know, this webinar that we put on about once a month covering different topics is really for the E&P operators. As an E&P operator, you're typically looking for suppliers that are performing at industry norm, which is the midpoint of the x-axis, or perhaps to the right most commonly. With that, let's go ahead and dive in on the responses and the feedback and what we learned from the 2022 Subsea Equipment Report. You know, one of the first questions that we asked the oil and gas subsea operators globally is what's been bringing them success to their subsea operations in the last couple of years or so. It's an open-ended question, and the operators are free to mention whatever they would like. When we read through the verbatim comments and we kind of put in the categories what the oil and gas operators are reporting back to us globally, what we find is that improved equipment quality and reliability, along with improvements in ROVs and AUVs, are right at the top of the list, followed by well intervention, digitization, boosting, and monitoring and testing type technologies have been bringing the greatest amount of success and positive impact to subsea operations. More specifically about equipment quality and reliability, it's everything from just better testing, better design, improved electronics, and it encompasses not just subsea control systems, but umbilicals as well as subsea trees and chokes. And so overall, the bar is being raised for the industry, and that's had a positive impact on your operations. When we look at these responses regionally, we do find that in the Gulf of Mexico, there's a whole host of different technologies that have made a positive impact. Whereas when you move more into Africa regions, equipment reliability, even Asia and internationally, tend to resonate towards the top. In Europe, digitization and ROV improvements tended to kind of resonate towards the top. When we look forward and we ask the subsea oil and gas operators globally, how will operations of the future be different than the way you operate today? The number one comment that comes back to us is, again, this is an open-ended question, and we take all of the comments. We just read through them and put them into these categories or buckets. But digitization, artificial intelligence, data analytics, and remote operations is clearly at the top of the list. You also see that there's some emphasis for all-electric systems and some lower carbon technology solutions, but AI and remote lead the list. It is interesting to point out, though, when you look at it regionally, Europe tends to be the most sensitive as it relates to carbon neutral solutions and all-electric solutions, whereas in Asia, carbon neutrality really wasn't even mentioned as a key feature of what they're going to be focusing on the future. In many areas, it's really around remote operations and the use of data analytics. Obviously, in the Gulf of Mexico, high pressure, high temperature plays a little bit larger role than it does elsewhere around the world. Well, if we take a deeper look into some of these lower carbon and new energy investments, since they tend to be kind of top of mind for many globally, what we find is that most of the oil and gas operators that we interview, and the same here at the Subsea oil and gas operators, are really planning to invest some efforts around carbon capture, followed by offshore wind and hydrogen. The major oil companies are clearly leading the pace here, and with a presence in just about all of these new energy investment areas. When you take a look at where ESG spending is increasing the most, it's mostly around carbon capture and reduced emissions and emissions monitoring. But then you do see a smattering of investments as it starts to break out proportionately into wind and hydrogen and other areas. When you take a look at where neutrality for lower carbon solutions is starting to show up in the subsea market, we've talked about moving to all electric systems in this industry for well over a decade. And today, when we repulse with the oil and gas operators around the world, we find that it's really the major oil companies that are really kind of leading the way, if you will, towards more all electric solutions. About 30% of respondents globally mentioned that they do have plans to move towards all-electric solutions. Gulf of Mexico, again, is tending to be the most active in wanting to electrify trees and chokes and manifolds and such. When you take a look at the impact of digitization on future operations, most of the operators will cite that, digitization will have a major impact on their future operations, principally around being able to remotely monitor in real time equipment and condition monitoring, also with data analytics to help to optimize the production operations. Also, as you begin to monitor more digitally, that may reduce some of the physical traditional in-person inspections that are required and may be able to change some of the remote inspections that are currently conducted offshore. In terms of having an optical feed-through as part of your subsea tree design, you can see that about 30% of operators are indicating that this is becoming a must-have for their future orders. Granted, not all tree suppliers have a subsea tree with optical feed-through, but I think as we move forward in support of the digitization trend and that we see that we think is going to stick in the future years, that having a optical feed-through and a subsea tree will eventually become fairly standard fare for the marketplace. In terms of impact of remote operations, that kind of ties into a lot of the digitization strategies that operators are implementing. Clearly, operators believe that the use of remote operations will play a major impact on their future subsea operations, again, tied to IMR and condition monitoring of the equipment and of the asset, being able to improve the efficiency of production operations. Again, all this dials into not just optimizing the performance of the equipment, but also remote inspections as well. All of this will hopefully drive costs down and efficiency up. In terms of the number of subsea wells that are outfitted with condition monitoring systems, we continue to see that increase each year. This particular subsea equipment report's updated every 2 years, like 2018 and 2020, and again here in 2022. And what we see is each year, the share of the subsea wells outfitted with condition monitoring continue to increase. 47% of the respondents that we interviewed for this year's survey indicated that they have condition monitoring on all of their subsea wells. Only 16% indicated that they're not quite there using that yet, but with plans to do so in the future. When we take a look at future expenditure trends, we are gearing up for a multi-year investment growth cycle. When we talked to the subsea operators, 61% indicated that they plan to increase their annual expenditures for subsea developments over the next 3 years. That's 2022, 23, and 24 versus what they spent in 2021. The diffusion index is well above the critical 50 index. Spending is expected to increase at an annualized rate of 13.2% per year, with the Gulf of Mexico kind of leading the way at 14.9%. If you take a look at the diffusion index, you can see back in 2015-16, which is not pictured on this graph, but we were below 50 index, and we broke back into expansion mode in 17 and 18, and then COVID hit in 20, where we took a kind of a slight dip, and now we're back up in the investment growth cycle mode. Most of the growth right now tends to be around shorter cycle barrels, around brownfield projects outpacing greenfield, about 6 to 4 ratio, 60% brownfield, about 40% greenfield, new project development. And the implications for this with these shorter cycle barrels and these shorter cycle projects is the need to get equipment delivered more quickly. What we find, though, however, is the actual delivery time for a tree is averaging about 18 months, with several oil and gas operators citing 24 months or longer. And for subsea control systems, average delivery time is about 15.3 months, and again, it's growing as well. Operators would like to have their delivery times in less than 12 months, particularly for the brownfield shorter cycle barrels. The implications for this for the industry is, although TechnipFMC and Schlumberger OneSubsea have over 50% market share of the subsea equipment market, other smaller suppliers may have an opportunity to establish relationships with oil and gas operators that can't wait the length of time that it may require to get their trees and controls and equipment from their traditional provider, and may be looking for other supplier opportunities. So we do see an opportunity for some of the small to mid-tier subsea suppliers who can deliver on faster delivery times to perhaps expand their customer base over these next 12 to 36 months. When we take a look at the impact that we've seen in the market with the alliances that have formed between the vessel contractors like Technip with the subsea equipment suppliers like FMC that formed TechnipFMC in January of 2017, Schlumberger has also followed suit with, forming alliances with Subsea 7 and Helix. And so what we find, and we've been tracking this particular impact on the industry dating back to 2016, In 2016, approximately 33%, or 1 in 3, of subsea oil and gas operators believed that these alliances would have a positive impact on the industry, and it remained at 33% from 2016 to 2018. But the subsea oil and gas operators who view this coming together of the vessel contractors and the subsea equipment suppliers as having a positive impact has increased each year since then, since 2018. In 2020, it increased to 47%, and now in 22, it's up to 58%. And so, generally speaking, the benefits that the oil and gas operators are finding through these alliances are, and you can see it in the text box to the right of the screen here, improved availability, better lead times, better integration, better access to resources and engineering teams. There's always going to be, I think, a segment, anywhere from 10 to 20%, that viewed this coming together negatively because it reduces competition. And sometimes oil and gas operators believe that they kind of lose control of the process when these integrated approaches take place. But we probed a little bit more deeply this year in 2022 on some of these topics. And what we find is CapEx tends to be the key driver in determining as to whether or not a subsea development is going to move forward or not over OpEx. So while life of field and TOTEX has a role in terms of the life of the operating expenses of a design and investment in the subsea, very clearly what we see here is that CapEx, more times than not, is the key driver. Also, that we find that the major oil companies and the national oil companies have the greatest belief in the value proposition that an integrated EPCI will help drive down cost, which will help meet the CapEx hurdles, whereas the independent operators, and which are principally oftentimes in the Gulf of Mexico, they tend to not buy in necessarily to that value proposition, and oftentimes would like to go select best-in-class suppliers for their components. For example, maybe they want master flow for a subsea choke and maybe oceaneering for an umbilical. Maybe they'll use an F&C or a Cameron for a subsea tree and control system. But oftentimes the independents will start to break out and select best-in-class suppliers. When we ask the subsea oil and gas operators what's the biggest driver in their supplier selection when purchasing a subsea completion system, and they were free to mention more than one factor, which is why these don't add to 100% clearly, but having an existing frame agreement and working with a subsea supplier that has alliances to provide an integrated offering, more times than not has a very important weighting in their selection. Followed by that is subsea trees, and then subsea control systems. So clearly these integrated alliances and integrated EPCI models do have some value and do have weighting in the selection process and the decision process of the oil and gas operators. Umbilicals, however, have been able to kind of separate a little bit from the trend on integrated EPCIs because about 62% of umbilicals are purchased separately outside of the integrated EPCI agreement. And, perhaps maybe that's part, one subsea is not a manufacturer of umbilicals directly, but through their alliances with SIA, they oftentimes will purchase their umbilicals either through Aker or Oceaneering, formerly Nexans, who's exiting the segment for now. And so umbilicals tends to run a little bit counter to the broader trend that we see with existing frame agreements and supplier alliances and the integrated EPCI arrangements that are taking place. If we take a look at kind of the market and brand image of the major subsea equipment providers, you'll notice that Technip F&C has a very strong market brand image in the marketplace that extends beyond their customer base. These positive variances simply indicate that they have very strong market brand image. Schlumberger OneSubsea also shares a very strong market brand image. Whereas if you take a look at Aker Solutions, they oftentimes have some brand image deficits to where even among some of their own customers and users, Aker Solutions in the overall broader market for subsea equipment are not necessarily viewed for being the leader in, say, high pressure, high temperature solutions and such. And so From a market brand image perspective, all this does is it helps to signal to the supplier that perhaps they need to invest a little bit more time and effort in communicating their track record that they have with the broader industry. Baker Hughes's image has been improving in the marketplace from a brand image deficit in 2018 to now. You can see they're starting to coalesce around the 0% line, indicating that Baker Hughes's customers are becoming more and more inclined to view Baker Hughes as a leader. So Baker Hughes' view of leadership in the marketplace for subsea equipment and technology and such has improved from 2018 to 2022 to where their customers tend to associate them as a leader. Non-users of Baker Hughes, however, are not necessarily viewing Baker Hughes as that leader, as you saw with TechnipFMC and OneSubsea. Some of the smaller suppliers like Oceaneering really stand out for strong aftermarket service and project management, whereas ProServe stands out for really strong aftermarket service and lowest total cost of ownership and project management. So if you take a look at the big four suppliers in terms of brand image and market image, TechnipFMC typically leads, followed by OneSubsea in second position. Baker Hughes is in third position, followed by Aker Solutions. Let's transition gears and let's take a look at the competitive landscape for subsea trees, then we'll go to controls and then umbilicals. When you take a look at the subsea tree market, obviously TechnipFMC and Schlumberger have the majority of the market share. When we ask the oil and gas operators, however, to rate the performance of their subsea tree providers on a scale of 1 to 10, with 10 being outstanding performance and 1 being very poor performance on these 7 performance measures like responsiveness to needs, equipment quality, reliability, competency of field service personnel, technical support, availability, aftermarket services, and pricing competitiveness, what we find is not all subsea tree providers are performing at the same level in the eyes of the oil and gas operators, the end users, the customers, if you will. So this is really a really good objective benchmarking, if you will, looking at responsiveness to needs and these various factors. So if you take a look at TechnipFMC in orange here, their customer review ratings in the 2018 survey, the 20 survey, and the 22 survey have consistently tracked on par or a little bit higher than industry average, where Aker Solutions customer review ratings have consistently trailed industry average. And so from an oil and gas operator's perspective, oftentimes if you use 1 or 2 suppliers, you may not really have a good feeling or an understanding for how the other suppliers perform. And then also as you start to move around regionally, say like in the Gulf of Mexico, if you take a look at responsiveness to needs, you saw that we saw a lot of declines in performance going into COVID, but we've picked back up coming out of COVID, whereas equipment quality and reliability continue to improve year on year in the Gulf of Mexico. So we're looking for overall industry trends. Every now and then you'll find a small supplier like Drillquip that has very few customers or very low market share compared to Schlumberger and TechnipFMC. But their customer reviews have been on the improvement trend of the customers that use Drillquip for trees. So what does this look like when you translate this to the value map? Let's just go to the Gulf of Mexico real quick. Like I said, TechnipFMC and Schlumberger have 90+% market share of the subsea tree market in the Gulf of Mexico, so it's really kind of a 2-horse race. Of the few customers and operators that have used Drillquip for a subsea tree, their customer review ratings come back favorably generally, and they're viewed as a value advantage supplier in the market. When you move internationally, though, what you find is that the competitive landscape begins to kind of separate out a little bit, where we see differentiated value. You've got Schlumberger up here, and the premium costs more but worth it. You've got Aker Solutions and Drillquip positioned more as a discount provider. Baker Hughes pricing strategies seem to be on par with industry norm, but their performance is slightly below industry norm. And then you've got TechnipFMC, who's viewed as internationally delivering some of the better overall value in the market for trees and certainly positioned to defend market share. or actually improve some of their financial performance. Currently, TechnipFMC's operating margins are sitting around 3%, and the stock price has been suffering due to financial underperformance. And part of it is just the fact that they're slightly undervalued. So from an operator's perspective, you look at TechnipFMC's financials of 3% profit margins, knowing that that's not a normal profit margin either for yourself, that it's probably likely that TechnipFMC will either need to raise prices and or reduce cost or some combination of the two to improve financial performance and to be properly valued into the marketplace. If we move to subsea control systems, it's important to point out that a good share of the subsea control system installations are for replacements of existing systems. As you know, subsea control systems are probably the number one component that fails the most often. After that, probably subsea chokes and valves and things of that nature. And so typically, on a subsea choke installation, it's not uncommon to have to replace it at least 2 times over the life of the asset, if not more. When you take a look at the subsea control system market, what you find is an independent provider, ProServe, is growing market presence and market share, particularly in the Gulf of Mexico. ProServe has very quietly grown into the number 2 position for market share in the Gulf of Mexico for subsea control systems, principally on the backs of the independent operators in the Gulf of Mexico. The major oil companies principally use TechnipFMC and Schlumberger for the subsea control systems. When you take a look at the performance ratings for the subsea control system providers on a scale of 1 to 10, again, we see quite a bit of variance. Not all suppliers are viewed as performing at the same level through the eyes of the oil and gas operators or the customers, if you will. In fact, if you take a look at the performance trends from 2018 to 20 to 22, you'll see certain trends where, say, Baker Hughes is improving every year, but they're not quite closing the gap with industry norm. You can see Aker's been improving every year, but again, not closing the gap with industry norm. And so you look at these trends. If you take a look at ProServe, that we mentioned, every year their customer review ratings are viewed much higher than industry norm, whereas some of the market share leaders, OneSubsea, Schlumberger, and TechnipFMC's, their performance ratings for equipment quality and reliability have traditionally been better than industry average, whereas Baker Hughes and Aker Solutions' subsea control system equipment quality and reliability has traditionally trended below industry average. So what does this translate to the competitive landscape? Obviously, on a global basis, ProServe is viewed as delivering the best overall value. Baker Hughes and Aker's pricing strategies seem to be on par with industry norm, but slightly underperforming. If we looked at this more regionally, you can see that the market share leaders are TechnipFMC, followed by ProServe, followed by Schlumberger and OneSubsea, the 3 market share leaders. But again, ProServe is very strongly advantaged, and it's likely to continue to defend and grow their presence as oil and gas operators begin to look for alternatives for maybe quicker turns on their subsea control systems in this environment where brownfield projects and shorter cycle barrels are being called up to help address the current market situation we have of supply and demand and elevated prices. When we move internationally, we start to see a much more commoditized type of profile where you've got Schlumberger viewed as the most expensive, ProServe is the least expensive, Baker Hughes positioned as a value-based alternative. Looking at subsea umbilicals, what we find is that Oceaneering's market presence has been growing in terms of market share, and that the 3 large umbilical suppliers, Oceaneering, TechnipFMC, and Aker Solutions, have principally dominated the market in terms of share over the last several years. When you look at the overall competitive landscape, we see quite a bit of performance variance from supplier to supplier when we get the ratings from the oil and gas operators on a scale of 1 to 10. And we typically find that Oceaneering tends to be performing better than industry average across the years in which we've evaluated the umbilical market, followed by Aker Solutions. When we take a look at the competitive landscape on a global basis, The pricing strategies of Oceaneering, Aker, and TechnipFMC are all viewed fairly equally, if you will, in the eyes of the oil and gas operators globally. The only difference is Oceaneering tends to edge out Aker Solutions and TechnipFMC in overall performance. Regionally, in the Gulf of Mexico, it's really a two-horse race, with Aker Solutions and their presence in Mobile, Alabama, followed by Oceaneering in Panama City, Florida. Again, with Oceaneering edging out Aker, but they're both viewed as performing pretty much on par with each other in aggregate. Whereas if you move internationally, you start to see more of a differentiated value in the eyes of the end users, the oil and gas operators. We find that Oceaneering is more positioned as that premium-based supplier. TechnipFMC is viewed as performing on par with industry average, and then JDR down here as a discount provider. Nexans is really focusing on the new energy play, and is really has announced they're exiting from the traditional oil and gas play as they focus on electrification. And I guess maybe if we take a quick look at subsea wellheads, when you look at subsea wellheads really quick, it's kind of a three-horse race between TechnipFMC, Drillquip, and Baker Hughes. And when you take a look at the overall competitive landscape, Drillquip continues to be positioned as kind of a value advantage supplier, followed by TechnipFMC and then Baker Hughes. We do see some differences regionally. Baker Hughes strengthens up their competitive position in the Gulf of Mexico, whereas internationally you can see TechnipFMC is in a very strong position. For subsea manifolds, typically what we find is that TechnipFMC is the market share leader, followed by Schlumberger in the number 2 position, and then Baker Hughes in the number 3 position. And so looks like we've reached the bottom of the hour, and so I would like to open it up, see if there's any questions that have come in that we need to address. But for the most part, this kind of concludes the Subsea Equipment Report overview. I'd like to thank all of the oil and gas operators that have participated in this particular industry survey, as well as our other surveys that we conduct on behalf of the industry at Kimberlite Oilfield Research. If you or your colleagues have a need for any additional information relating to this report or other report categories, be it drilling or completions or production, feel free to reach out. Overall, the backdrop for the subsea industry looks like we're going through a multi-year investment growth cycle as the call for barrels and the use of fossil fuel continue. Supply chain constraints and capacity constraints will continue to be a major challenge for the industry. Delivery times are expected to extend, so if you're an oil and gas operator, really encourage you to get out in front of your supply chain and get out in front of your needs. And you know, it may be too late, but or you may have to start to explore other avenues if you have a need for shorter delivery cycles, or perhaps improve collaboration with your frame agreement supplier to see what can be done to standardize and improve delivery times, allow you to get your projects to stay on schedule. So with that, we'll sign off here at Kimberlite Oilfield Research. Thank you for attending the webinar, and please call if you need any help or would like to discuss any of these areas in more detail. Thank you very much.